Hey Tony, first off, we want to thank you for coming to us with your business issues. We here at Dixie Consulting appreciate your business and really take pride in finding the right solutions to your problems. We put together a team of our finest employees, including myself, Logan Nielsen.
Myself, Chris Geem.
Nathan Moses, Jared Hall.
We went over your current situation and each took the time to dig a little deeper into some of the problems Darby and Larkin are facing, and we've prepared some recommendations regarding these situations and have come up with some decisions you may want to consider going forward.
Okay, Tony, as it pertains to your first question dealing with what factors need to be considered and how costs are assigned and used in profit analysis and performance evaluation, we feel that the current allocation base of total billable hours is unfair. Some of the practices don't utilize the administrative expenses as much as the others. To create a more fair allocation method, we need to know how much each group is using the individual administrative expense. We would need to know certain rates like insurance premiums per employee, how much training each practice does and how often, how many subscriptions each practice has, mortgage interest of each building, and the buildings each practice utilizes. We need to break down each individual administration expense to find the appropriate cost driver. Doing this will allow Darby and Larkin to fairly allocate costs to each practice and better reflect the profits of each practice. On terms of performance evaluation, Darby and Larkin should not consider administrative expenses that management have no control over, such as insurance, property tax, mortgage interest, and utility rates. Doing so will allow you to evaluate the practice better even when economic circumstances change.
On to your question about the evaluation of the bankruptcy practice. There is an issue with how the costs are being allocated, which is making it seem less profitable than it actually is. Currently, according to the profit and loss statement that you provided us, the bankruptcy practice is generating a negative operating profit of about negative $56,000. They are not currently participating in the bonus pool, which has the group concerned. This practice does not work in an office building, rather they all work from home. The statement shows costs for the bankruptcy department that they are not incurring during operations. These include mortgage interest, property tax, building maintenance, equipment purchases and maintenance, and utilities. In total, these come to about $85,000. If these were to be removed from the bankruptcy practice's costs, they would be profitable at an operating profit of about $29,000. This bump in operating profit could be a morale booster for the practice. To be able to forecast the bankruptcy's operating profit for the future would require further analysis of the past year's profit and loss statement for this practice. It is a growing practice and more time is needed to really see if they are profitable. We believe that the bankruptcy practice has allocated more costs than necessary and think they should not be sold off in their current state.
Tony, there are a few factors that need to be considered before a merger takes place. Mergers can be very difficult, expensive, and time consuming. This can lead to internal problems at your firm. It is important to first and foremost gain feedback from current staff and employees about the potential merger. One of the main factors that needs to be considered is the corporate culture. Currently, the office in Corona is practicing in new areas of law that you and your staff are not accustomed to. Each department generally handles certain situations differently. It is important that you communicate with your staff as well as the staff at the Corona office to make sure that the cultures of the two firms can coincide with each other. Each firm's staff should be working together, and if they feel they're in competition, then referrals will be lost for the other departments. A large change in culture could push current employees to leaving the firm, especially if some staff members are unhappy with the bonus they received this year. Employee turnover can become very expensive, and on top of the cost of the merger, you could see profits decrease rapidly. Because of this, we would recommend that the new firm be included in the yearly bonus pool. This will keep the departments fair between each other and would likely decrease the potential for a hostile work environment for your employees. Another factor is that the financial position the other firm can bring to you. The merger is a 50-50 in the end, but you need to conduct the research into the firm's financials to confirm the profits are strong. It is important as well as to gain access to clients as a contingency of the merger. The new firm could attract new customers to your practice and you can provide further referrals to other departments. We would recommend a 5-year review of the financials if available. Talk with your accounting staff and that prepared the financials and tax returns and ask questions. It's important as well as to construct a 5-year forecast with the current firm's operating averages with Darby and Larkins and a 2-year budget ahead of time to prepare for additional expenses because of the merger. If the merger shows substantial benefits to Darby and Larkin, then we would recommend pursuing the merger. We commend you for continually trying to grow the firm even with internal problems. However, it is important that you remain patient and perform your due diligence before you act upon the merger.
Tony, after analyzing your current bonus payout method, we've concluded that the focus on net profit doesn't fairly compensate employees in new business groups that are getting established or groups that are able to operate on fewer employees because they are supported by other groups. What we would like to recommend is an approach that uses a more balanced 4-part scorecard that places a higher emphasis on contribution margin instead of operating profit, but also includes elements of operating margin, revenue growth, and operating profit. Additionally, we would suggest adding a bonus incentive to staff and professional employees to reduce administrative expenses and costs of services as a percentage of total revenue. So just to move on to the different parts of the bonus. So it's a 4-part scorecard. The first part would be the practice group contribution margin relative to the total firm contribution margin. So right now, the total firm contribution margin is 45.6%. So practice groups with a higher contribution margin than 45.6% would receive a larger portion of this bonus, and practice groups with contribution margin lower than the average would receive a lower bonus based on this. So right now, at 45.6% of the bonus pool, that would be $99,500. That would be allocated between the groups based on their relative contribution margin. The next portion of the bonus would be a flat amount that's based on the operating margin of the firm. So this past year, the operating margin was 7%. So based on that, the flat bonus would be a total of approximately $59,000 split between all the 34 employees at the firm. That would average out to $1,508 per employee. And that would be a flat bonus that everyone would get the same. The next portion is a performance bonus based on revenue growth of the group as a percentage of firm revenue growth. So this aspect of the bonus recognizes growing parts of the practice independent of whether they have achieved operating profitability. This reduces the risk of losing valuable employees in a fast-growing but not yet profitable group like bankruptcy. So that would be approximately $29,500 based on last year's performance. That would then be split between the practice groups based on revenue growth. So a fast-growing group like bankruptcy would receive a larger portion. The last part of the performance bonus is based on relative operating profit, just like the entire bonus has been calculated in the past. So that would be another $29,500. That would be split based on relative operating profit. Now, we would also recommend a bonus that incentivizes reduction of administrative expenses. That's one thing that you had noticed that you had asked us to look into is the escalation of these expenses. So what we would recommend are a 2-phase bonus. One is a bonus to incentivize reducing the administrative expenses. That one is designed to reward the office staff. And the other bonus is to incentivize reducing cost of services, which is more to incentivize the non-staff employees to reduce their expenses. So I have a scenario example here where if there was a 1% reduction in administrative expenses and a 1% reduction in cost of services, what the result would be. We would also like to recommend a new aspect to the bonus, and this one is designed to reward office staff and non-staff employees for reducing expenses at the firm. So this bonus to incent reduction of administrative expenses would be to increase the staff bonus pool by 1% of operating profit for each 1% reduction in administrative expenses as a percentage of total revenue. The other bonus would be to incent reduction of cost of services, and that would grant a net profit participation of 8% for each 1% reduction in cost of services. Our calculations indicate that an increase to the bonus pool in each case is far outweighed by the increase to net profits attributable to the partners. So I wrote out one scenario here where administrative staff has achieved a 1% reduction in administrative expenses, and non-staff employees have received a 1% reduction in cost of services. And the result of that is that the average staff bonus would be up $1,750. That's actually a 71% increase as a reward. The average non-staff bonus would be up $2,590, and the average partner income would be up $15,795. And this is based on the same revenue that you achieved last year, but just a reduction 1% in each of administrative expenses and cost of services. Tony, we appreciate your time. We're confident that if you implement the recommendations that we have suggested, that your firm will profit. If you have any questions about the recommendations that we've offered, don't hesitate to call us. We are here to help.